original.
And I'm in love with the money.
Welcome, Maryam. Today we're going to talk about where the money is coming from. Where is the money? And this is in business scenarios. Maryam is the founder and principal lawyer at Venture House Legal, and she has experience in litigation, but now she's focused on business and estate law. Maryam, could you add to your introduction?
Sure. Thank you very much, first of all, Cardine, for having me here. I am a business lawyer. I was a former litigator, still do some litigation here and there, but this is definitely my passion. And I have a strong focus in helping clients with wealth building. And to do so, I partner up with people such as yourself, financial planners and such, to ensure that and make the process seamless as possible. And I typically serve boutique businesses, but startups and larger companies are also welcome, no problem at all.
Awesome. And I know from my experience, and I'm sure in your experience too, you've found that a number of business owners kind of start and they get into the grind of business, but they haven't thought about the end. They haven't thought how they will exit the business or made provisions for that. So today we're going to talk about how they can find the money. And this is in the scenarios where they're thinking of exiting the business. So, Maryam, for example, if someone wants to leave their business, they're incorporated, they're co-owners in the business, and they wanted to exit, what kind of challenges this could create, and how do you think, or what are some options for mitigating these challenges?
Well, more often than not, surprisingly, I find that people don't have, or rather partners don't have, a buy-sell agreement in place, which actually outlines the terms as to how to purchase back the shares. And the reason that's important is because if you were to sell the shares, there is a capital gain tax that's going to be triggered. So when the corporation buys back the shares and it's perhaps reissued, again, there's a little bit of a tax efficiency there, right? So, however, even before getting into that, let's say in the ideal situation, there is enough money and capital in the corporation where they can buy you out, whether that be in a lump sum, whether it be in installments, whether it be terms as in, okay, you can get 50% now and the rest can be paid out within over a 6-year term. You typically have to have capital. In the case that there isn't enough capital, then what do you do? Where's the money? So what was the point in investing and being a shareholder or being a partner in the business when you can't access it? And that's where insurance proceeds absolutely helps, and you can acquire those funds in the most tax efficient way, because as you can see with capital gains, it's not our friend these days. So it never really was, but right. So you want to ensure that you have more money in your pocket in that way.
I know, right? Know that they've increased the capital gains tax on corporations and trusts to inclusive rate of 67%, right? That's a chunk that will be taxable. And you are right, using your insurance policy is a way to ensure that there is sufficient funds available to facilitate a buyout, right? And at what point, you've mentioned a buy-sell agreement. What document is that a part of?
Well, it could be a standalone document, or you can also have a shareholder agreement if you have shareholders instead of business partners. So one or the other, typically there are clauses in the shareholder agreement that facilitate that. In addition to clauses such as valuation, because you have to evaluate the shares, you have to get an appraiser. All of this costs money, right? So people don't think of these added costs and these business expense. They just think, okay, I'm just going to pull out my shares and I'm going to have all this cash. Well, how do you do that? How do you go about that? Is there enough capital to do that? So you have to implement these strategies, because if you don't, even if you have the capital and they do give you the money, you are subject to the capital gains on top of that. So it's about making sure you get the most bang for your buck, if you will. So that's
exactly. Why. And what I love about you saying that you can use an insurance policy to do this is that an insurance policy can act as a wealth warehouse, right? Yes. Permanent policies, whether it be a whole life policy or a universal life policy, you can stash cash over the years to build that wealth warehouse So when it comes to that point where you need those resources to either facilitate a buyout from the shareholders agreement from an owner, or to facilitate other investment options, you have that storehouse of cash that you can leverage to facilitate these transactions.
Yes, absolutely. Absolutely. Insurance, it's not a secret, but many people don't know how to utilize it. And it is, I believe, in my opinion, one of the primary sources to create that generational wealth or to wealth build, and to also protect you with circumstances. For instance, if you were ill, what are you going to do in that situation, right? You can speak to it a little bit more in terms of purchasing critical illness. But if you are disabled and you can't run the business, of course there are certain things that you can put in. I can speak about that, but that insurance will absolutely help you without needing to liquidate any types of assets or shares or anything of the sort, to just facilitate that period to keep the business running and operations costs and etc. Right? So it's a very, very important tool, very beneficial, and I highly recommend it for business owners.
Yeah, and again, start with the end in mind, right? So it's creating that reservoir that you can pull on without having to sell those other assets that you'd rather keep to help you generate your income in the business, right? And there are multiple ways that people want to exit a business. We're talking about one where one partner wants to leave, right? There might be a situation where the owners want to leave it to their kids. How does that work out?
So of course, a strategy would be that, again, the insurance is names the beneficiary as the corporation, and the corporation buys the assets, and then they're able to provide cash in that value to the beneficiaries. There's another way, I would believe it's called the capital dividend account. Of course, speak to your accountant about this, but this is monies that can be paid out to the beneficiaries tax-free, more money in the beneficiaries' pockets. A lot of the time, sometimes they want to either, again, it depends on the scenario when it comes to children. Sometimes the parents want to leave the legacy of the business to the child, so there's a different strategy in place for that, state freezes and things like that. Or they just want to make sure they benefit from the cash value of it, and how do we structure that tax-free? So again, insurance policies need to be put in place, and I always recommend work with an accountant, even more so a tax consultant, because they can put those strategies in place for you to make sure you get that money tax-free. I like saying tax-free. It's my new favorite word. So it's tax-free. We need a little bit of break with the taxes.
We do need a little bit of break. And the thing is too, depending on who owns that policy, you mentioned that the corporation can own the policy, the corporation can be the beneficiary, but the individuals within the company are the insured. They're the lives insured, right? And in between the point where the policy is taken out and the passing of that insured person, there are opportunities to use that cash value to support the business, or to even help that person, say, to fund their retirement, right? Leverage that capital to fund their retirement. So if they're wanting to transfer it to their kids, is there, again, it's the estate. If they don't pass, if they're wanting to do that before they pass, how can that be facilitated?
Well, I would say you have to have a strong succession plan in place. Estate planning is key here. You have to basically see what's going to happen with your business. What do you want to happen with your business? You should have wills in place. I recommend primary and secondary wills. Specifically, secondary wills deal with the shares, the corporate shares. And what people don't understand is that this specific will, it doesn't have to be probated. So if you have shares for the value of $1 million, that will not be probated in tax when the primary will is provided to the court to get the certificate. That's a lot of tax savings. So have a succession plan. Figure out, do you want a successor to the business? If there is a successor, do you want individual policies on those individuals? What do you want in in place. And if you don't want a successor, you just want to leave it to the children, that's when you have to talk to your tax advisor and also make sure the agreements in place, whether it be the buy-sell agreement or it be a shareholder agreement, to specify how that will go about. So again, I mentioned the capital dividend account is a popular method to use because the beneficiaries can retrieve that money, the cash value of it, tax-free. And there's other share redemption clauses as well, or mechanisms as well. I'm not absolutely sure, I'm not an accountant. I don't think it's tax free, but it is more tax efficient. So again, it just depends on the situation and what would best serve the scenario. These are just a few mechanisms that I'm actually quite aware of and I implement in my contracts.
Exactly. And aside from a transfer during life of the owner, right, where you can use the cash value to support a buyout and pay off the associated capital gains taxes. If somebody should pass in their business, then there is the death benefit payout, right? And that, again, you mentioned probate, and that probate process can take quite a significant chunk of time. And in the interim, the family is there and it needs financial support. So the life insurance policy payout actually helps the family to continue the business, continue living, and maybe even access resources that they might need. Maybe it's the skill set that's lost. They can go ahead and replace that in the business so the business can continue to work and support the family. So life insurance, again, it can help in multiple scenarios. How a business winds up might be different, whether it's triggered by somebody choosing to leave or somebody leaving because of death, right? And those scenarios can be assisted with life insurance, funding a buy-sell agreement or a company owning the policy on the owners as the insured, right? And there is another way people might leave the business, right? You mentioned it just now, when they become critically ill or disabled and they just can't work in the business anymore, right? Have you had situations or heard of situations where that has happened? What's the implication?
Oh, many situations. I mean, unfortunately, you can fall ill, and let's say you found out you had cancer. I mean, it's a pretty big thing, and you have to go for treatment. Who's going to run the business? Are you going to appoint a key person to run the business, a successor, or are you going to have to shut down the business? Or even if you have the successor, who's going to pay the operational expenses, the critical illness? You could probably speak better to this. I believe it could be set up in a way where either you get monthly payments. I don't know if you get a lump sum, whatever the case is, to facilitate these expenses. I think for you, what I would like to ask is, a lot of the questions I also receive from clients is they don't qualify for critical illness. Maybe they came into the game a little bit too late and they discovered some illnesses. Is there any way to structure critical illness to still for them to still achieve that or get that? Would we be able to speak to that?
Okay, sure, definitely. So there are a number of ways that you can provide for a business when you can't show up, right? Critical illness, yes, it knocks us off our feet, and recovery can be extended. And some people just can't come back to work at all, right? It could be an accident that causes a disability that allows you to not be able to work, right? So in these scenarios, you want to ensure that you have critical illness coverage. What critical illness coverage does is that it pays a lump sum to you after you've survived a diagnosis of a critical illness for more than 30 days, right? The corporation can own this policy, or you can own this policy individually. What this does, this lump sum, it helps you with your personal expenses, your living expenses, your medication, and it could also be a source of funds for you to inject into your business to find that substitute to operate the business while you're out of commission, right? And you mentioned it. Some people are forced to sell. Some people are forced to liquidate because they don't have these measures in place, whether it be life insurance, critical illness coverage, or disability coverage. Disability coverage is the one that gives you a monthly payout, right? So critical illness, lump sum, disability gives you a monthly payout based on your qualifying income, right? So these two things are very important. Again, we don't want to suffer should these eventualities happen. you want to be able to still support your family, still have your business going. Another
Yes.
option too is business overhead expense coverage.
Mhm.
So this is a, a policy that you can put in place that if something happens to you, you work in the business and you can no longer work in the business, whether it be for a critical illness or disability, you have these expenses, your fixed expenses, your rent, your loan payments, your utilities, your admin staff, all of these costs are covered by your business overhead expense coverage. So there are multiple ways to do it. So if you don't necessarily qualify for critical illness coverage, then maybe have a look at business overhead coverage, right? To see how that works out for you. If you had a previous instance of critical illness, yes, it does make it hard to qualify for coverage. They say it's health that buys insurance, it's not money, right? So
Mhm.
that's why it's good, as you said, to get it early, right? So
Yes.
before you start having these um, things pop up in your life that comes with aging, right? You have the coverages in place. So when it happens, or if it happens, you're prepared, right?
Yes.
And for CI coverage, critical illness coverage, or disability, there might be cases where the insurer might be willing to issue a policy with some exclusions. For example, if you had cancer before, they might be able to issue a policy with the exclusion of cancer, right? So if it were
Mhm.
a heart attack that came afterwards, then you'd have that lump sum payout. So each case is different. That's why we have an application process whereby we ask certain questions to see what you'd be um, able to qualify for. Yeah.
Excellent. I mean, that's actually very I don't think people think of those scenarios because everything is fine in the moment, but
Mhm.
life happens. And I'm always somebody with regards to any type of contract, I say one of the most important clauses is the exit plan. What happens if X, Y, and Z happen? You have to prepare for the worst. Maybe, you can think of it as pessimistic and all of that. It's not. It's being cautious and seeing enough that's happened to people that has been a surprise that you have to really plan for it. And that's just the way to do it. And that's just how I do it and how I advise my clients. And I'm sure you advise yours as well. Something else is
Exactly.
that when it comes to the wills, people, they're a little bit confused as to how insurance works. Insurance is a contract that actually supersedes the will unless you've named the estate, which I wouldn't necessarily recommend because then it can
Yeah.
go, depending on how
Into
it's drafted. Yeah, it could go in the residue and pay probate tax, and that's not what you want, right? So it
no.
needs properly drafted will to make sure you get those insurance proceeds properly and it's allocated accordingly to the beneficiaries because that's why you have it, right?
Yeah.
But yes, I'm a huge advocate for insurance.
Me too, right? And the thing too, it's not all about things going wrong. It's a tool, for example, that business owners can use to plan for their retirement. That same cash value that builds up, if you don't use it for a buyout or if you use it for that too, when you have residue that you can use to fund your retirement using a collateral loan, you can leverage that policy to access cash to help fund your retirement and maintain that quality of life, right? So it is a multifaceted tool that can be used in multiple situations. It's definitely a must have in my mind, right? Whether you're an
Yeah.
individual or a business owner.
I also think, and you can correct me if I'm wrong, if you have children, you can also take out policies in the children's name as well. Is that correct?
That is
Very
correct. You can take out policies where your child is insured. You are the owner and the payer of the policy. And a good thing too is that you can transfer that policy to the child when they become of age and it trigger no taxes. So talk about legacy planning, right?
There you go.
And
There you go.
yeah,
Hey, here for wealth building. This is how you do it.
exactly. Exactly. And the good thing about using it like that is that that cash value that is built up you pass on to the child, and they can use it in their businesses, in their lives. So they don't have to wait until you passed to enjoy that legacy. You can actually watch them enjoy it. So that's one of the pluses in my mind of creating policies for your kids that you can later transfer to them, and they can access that wealth to do whatever they want to. Start a business, fund their education, deposit on a home, whatever they want to. And as parents, I know we want the best for our kids, right? And that's definitely one way that we can do that for them.
Absolutely, absolutely.
So we've touched on a few things, right? So
Quite
hopefully,
a bit.
hopefully our listeners take one thing at least: be proactive, right? Have the end in mind and plan for it, and use an insurance as a tool to help you protect your business, protect your family, and build that reservoir of wealth that can support the exit strategy from a business, whether it's an owner wanting to leave, whether it's an owner wanting to leave it to their children but having resources to pay the related taxes, or if they just pass and they want the to have that injection of capital to their families and to the business that allows it to continue. All right. And critical illness, disabilities, these are things we want to hide our faces from, but they happen in life, and we do want to be prepared rather than sorry that we weren't, right? So Marianne, thank you so much for joining me. Do you have any parting words for our listeners?
I'm just very grateful to be on your podcast, for your show. I'm very happy. Thank you so much for the opportunity. And yes, go to Cardine to get some insurances, and then come to me for some contracts to facilitate that.
Yes.
So
share your contact information with our viewers.
yeah, so I am the owner of Venture House Legal. You can call me at 647-701-1425, or you can visit my website at www.venturehouselegal.ca.
And of course, I'm Cardine Williams, your insurance specialist. Reach out anytime. Our information is also scrolling across the screen. So reach out, we'll help you. Thank you very much for listening.
Thank you. Thank you very much.